you. Welcome back. We are in the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. Kay Rooney on what's behind the move in SoFi and Robinhood. Courtney Reagan looking ahead to Lulu in overtime today. Mike, when you look at this market, a lot of outsized movers. United's down 5%. Delta's down pretty big. Palo Alto's down. Vertiv, AppLovin's getting crushed. What's your take on what's happening here?
A lot of those are stocks that have a high beta to sentiment of the moment. Travel stocks are kind of among consumer cyclicals the ones that sort of whip around the most based on if people are feeling better or a little bit worried on a given day. And then, of course, the Palantir, those are kind of the adrenaline favorites. So it's all netting out to sort of not so much, a very hesitant market. It's not really spry. We did actually have this pullback this morning that exactly touched for half a second Friday's low. And I think a lot of the sort of mechanized systems were like, oh, great, we filled that gap. Let's go. We're off to the races. Now, we're not off to the races, but we are holding steady. It's a test of how far we can go with oversold conditions, sentiment being pretty negative right now for a couple of weeks, and then just a steady state of the economy. It's not falling apart yet in the data, and also trying to see if we can just separate out directly tariff-impacted stocks from everything else. So far, tentatively, it's working.
I'll come back to you in just a minute. Kay Rooney's going to tell us what's happening with SoFi and Robinhood today, Kate.
Yeah, Scott, so SoFi, if you take a look at that name, down about 6% into the close. It is on the back of Robinhood launching a competitive banking product. So Robinhood earlier came out with a suite of wealth management offers. It does include a more traditional checking and savings account with a 4% yield. They're offering transfer bonuses, too. So really trying to incentivize customers to move money from other banks and brokerage firm. It all raises some questions about more competition out there for SoFi, growth prospects. There is also a major overlap in some of these younger investors in the audience that both of those companies target. And then you got the market factor, investor sentiment, some of these high beta names that Mike mentioned also weighing on SoFi, and other growth names. Coinbase lower today, too. And Robinhood, not immune. It is down slightly heading into the close, despite some of those announcements. In addition to banking that I mentioned, they're launching a low-cost robo-advisor plus an AI investing assistant, Scott.
All right, Kate, thank you. Kay Rooney, Courtney Reagan. Brutal lately for Nike. What to expect now from Lulu and OT?
Yeah, Scott, so Lululemon might be on pace for its best week since December, but shares are still down 11% so far this year. Make a good point with Nike. Now, that down 11% is in line with the retail XRT ETF, but it's much worse than the broader S&P 500. And so while Lululemon had a pretty strong pre-announcement in January, according to B of A, it's actually pretty typical for them and then often followed by a beat when the full report is out. We'll see if that happens today. But it likely doesn't really matter either way, actually, because the street's squarely focused on the current trends. So Needham tells investors it believes trends have improved for Lululemon in recent weeks. So any slowdown in January or even February can be overlooked. But Jefferies' Randall Koenig, he's not so sure. He expects Lululemon's U.S. sales could fall this year in 2025 for the first time in company history outside COVID. His analysis, along with data from Placer.ai, suggests that web and Lulu store traffic is slowing and potentially starting to underperform peers. So there's kind of a lot to look for in this report, Scott. We're going to look through the tea leaves.
All right. Court, thank you very much. That's Courtney Reagan. We have less than about 90 seconds to go. PCE tomorrow.
Yeah, I think people are feeling somewhat more comfortable about it. You can kind of predict it based on some of the other data that we have. A benign number would at least, I think, get one concern out of the way, maybe lessen the effect of some of the hawkish Fed speak we got this week about, tariffs. By the way, 1 year market-based inflation expectations have really ticked higher. So there is this way that the market is bracing for, some kind of a surge in stated inflation, but it's kind of hoping that the Fed is more or less going to let that be.
Look at yields. Look at yields lately, Mike.
Yields are firm. They are. Longer-term yields are firm. I think it's, again, okay at 4.3. At 4.7, it starts to get to be a little bit of a squeeze. So it is, it's a kind of this delicate equilibrium that we're dealing with right now. And again, just in terms of the hard data, I mean, weekly claims were fine, so every day you have to go through the checklist and say, do we see signs of more than just a growth scare, more than just a sentiment bust? And not yet, I guess, is the answer. We are at these kind of funny levels. We're only 3 or 4% above the lows that we got in mid-March in the S&P 500. So it's got to start to get moving soon. Semis, capital market stocks, they're still weak right now.
Okay, good stuff. I'll see you tomorrow. So we'll go out red. And pay attention to any CoreWeave news coming in the next couple of hours. We'll obviously have it for you as it comes to us. Into OT with Morgan.
That's the end of regulation. Dow Jones ringing the closing bell at the New York Stock Exchange. Wing VC doing the honors at the NASDAQ. Stocks finishing lower as tariff concerns weigh on sentiment, but the major averages are still pacing for gains on the week. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. Well, ahead this hour, we are awaiting pricing for one of the most hotly anticipated IPOs of the year, AI play CoreWeave. We've got much more on that in just a moment. Plus, we'll get the latest read on the high-end consumer when Lululemon reports earnings results. And Fundstrat's Tom Lee will join us with his take on the wild market action we've seen lately and where stocks could be heading in the second quarter. Because we're just a couple days away from that. But let's get straight to the market action with Henning & Walsh Asset Management President and CIO Kevin Mon and BD8 Capital Partners CEO Barbara Duran. It's great to have you both here. And as I mentioned, all the major averages finished in the final moments down here today. So second down day. Most of the sectors in the S&P, it looks like finishing lower too, Kevin. We've seen a lot of volatility this March, which also maybe not be that atypical for March in general when you think about seasonality patterns historically. Your take on where we go from here? Yeah,
talk about seasonality. I think March Madness actually started in the stock market this year as opposed to on the basketball courts, as the S&P moved into correction territory in just 16 trading days. However, if I can expand upon that basketball analogy a little bit, I can create final four factors that I believe will lead us forward in terms of market activity. One, tariffs and trade, if we get more certainty around tariffs and trade. Two, the Federal Reserve, if in fact they continue with their 2 rate cuts this year, that could provide some tailwinds for the stock market. 3, continued spending as it relates to both artificial intelligence and as it relates to defense spending. 2 themes that were in place prior to this market pullback that I think will continue for the balance of this year. And given the pullback that we've seen, Morgan, we have some real attractive investment opportunities to consider. So tariffs and trade, the Federal Reserve, ultimately what's going to happen with AI in terms of spending and defense spending. Yeah, and of course, we should get some more details on tariffs and trade, and we have been on a daily basis, but April 2nd is sort of being looked at as the next kind of key day for that. And right here on Overtime, as we mentioned, another key barometer on AI will be CoreWeave if we get that pricing here. Barbara Duran, I want to bring you into this conversation. Your thoughts on the market here as we have all the major averages finishing down fractionally here. But again, a lot of uncertainty in terms of what moves us higher if we do go higher in the near term. Your thoughts?
Yeah, no, I happen to agree with Kevin on the 3 things outstanding with tariffs, number 1. But what I find interesting, he mentioned how quickly this correction has happened. And I think the market, in times of great uncertainty with unknowns, the market discounts the worst case. When they don't know, it assumes the worst. And I think we're getting pretty washed out in here because you're starting to see I've been looking for no reaction to a big tariff announcement. And you look at today, the market went down. The low was right after the opening, and then it sort of went positive. It's been hanging in there. I think investors are getting inured to the constant Trump tariff threats, which then he backs off. And now, for instance, it's been a question, is he using it as a negotiating tool? With TikTok and China, he'll cut back on tariffs if they let the TikTok deal go through, that sort of thing. So I think we're going to see more of these pronouncements, but I think investors are getting a little numb to it. And I also thought it was interesting last Friday when we had bad consumer sentiment numbers, the market actually had a big rally day. So I think the market is discounting an awful lot. And as Kevin said, there are some very interesting opportunities that have opened up, that I think you can be cherry picking along the way. And if you have cash, I certainly have been putting it to work. And by the way, for the first time, I've been adding some gold to the portfolio because I think that is a long-term secular trend with the central banks buying. It's very different than it's been used in the past as a defensive hedge against uncertainty and inflation. But that's the one thing I have to say I've been adding. So I think there's opportunities in here. Not that the volatility is over. I think that continues for a bit till the tariff uncertainty settles down. Okay, so you're a gold bug. Kevin, I want to get your thoughts on where you see the opportunities. Barclays today put out a note. They basically said markets are underpricing trade risks and that they're switching their preference to global fixed income over equities. Yes. Do you think that's the wrong move? How do you see it? Well, let's look to the second half of the year now that we're nearly the end of the first quarter of the year.
if during the second quarter of this year we get more certainty around tariffs, if in fact the reciprocal tariffs aren't as bad as we originally thought, if in fact the tax cuts are extended, and if we learn in June that the Federal Reserve does cut interest rates by 25 basis points, those are three pretty strong tailwinds that could ride us out for a strong second half of the year. But I go back to those themes that were underlying this market over the last 2 years. If you look at the Mag 7, right now they're trading at about 25 times forward-looking earnings. That's the lowest they've been since the end of 2022. You can't tell me that NVIDIA, Microsoft, Alphabet, Amazon are going out of business. In fact, I'd make a very strong argument right now that we have a very long road ahead in terms of the AI revolution, which could benefit CoreWeave, in fact, over the long term. And we'll learn more about their forward-looking guidance in terms of their IPO announcement. And then defense spending across the globe. We see countries, regions, including the U.S., continuing to commit more dollars towards defense and security. So look to the large defense contractors to benefit from that as well.
Yeah, and of course, we could get a reconciliation deal taking shape in a more meaningful way as soon as next week as well. And I don't think defense spending here in the U.S. is going to decline. It's just some of those dollars are going to get reallocated.
Exactly right.
So Lululemon results are out, Barb, and I'll just note we're going through those right now. We'll bring them in just a moment. In the meantime, that's sort of seen as a key barometer on state of the consumer as everybody's debating the health of the consumer, given some of these confidence numbers and other metrics we've seen. And then, as Kevin just mentioned, CoreWeave as a barometer on the AI trade. How do you think of both of these?
Well, Lululemon, of course, has been a big, in a way, a turnaround situation. You know, at the end of 23, they were at a high of $510. The stock, as you can see, is about $325. They missed numbers, hadn't happened in a long, long time. Question was, were they losing share to some big, important competitors? You know, had they lost their mojo? Well, they made some important management changes. They got their merchandising back on track, and it looks like the holiday season in all categories, all regions, they did very well. Now, what's going to happen here, we're going to get a read on what's going on in January, February, which was probably down. There's always, you know, post-holiday, a little bit of slack, had some bad weather. And you've also had, as we've talked about, the consumer sentiment. People have been holding back a bit. They're still spending. They have the money, but they're really uncertain. Headline day after day about the tariffs are hurting the growth and inflation. They're not sure what's happening. So I think Lulu, it will be interesting to see what they're seeing out there. I don't necessarily know that there's a good forward read through it, because I think the consumer right now could be in a stutter step situation. So we'll see about that. And CoreWeave is interesting. I feel bad for them in a way, because if they had just done this IPO in December or November, you know, when the AI mania was really hot. But right now, there's a couple things. One, to do an IPO in this kind of volatile market, not great, you know, in any stock, no matter what. This one, AI, people have been going through this with a fine-tooth comb, and you've seen huge analysis in the media about this and their high debt and their, you know, almost obsolete inventory, which they're using to collateralize their debt, and, you know, all sorts of hair on this. So I think we'll see what happens. They've got to definitely, I think, price at the lower end because of all the issues here. So, you know, cash burn's a big issue for them. We'll see.
All right. Barbara Duran, Kevin Mon, thank you both for kicking off the hour with me.
My pleasure.
Lululemon earnings are out. Shares are down right now. Courtney Reagan has the numbers for us. Hi, Court.
Yeah, Morgan. So it was a beat for the fourth quarter, but analysts are looking past that. Let's get through the fourth quarter first. Earnings per share for Lululemon, $6.14. The street was looking for $5.85, so that's a nice beat. Lulu revenues coming in at $3.61 billion, also better than $3.57 billion expected. However, if you look at the guidance going forward, that is disappointing there. And also, even the fourth quarter same-store sales were disappointing, up 3%. The street was looking for 5%. And Americas, that was flat. That's obviously the biggest and most important region. International growing, sure, but smaller. And those same-store sales were up 20%. So much of the growth not coming from Americas. That is the key region. Gross margins for the fourth quarter were 60.4%. That was better than the expected 59.7%. But again, it's that forward-looking guidance, and there's not much commentary here from the executives other than sort of reiterating their power of three mantra, that strategy going forward. So we need a little bit more color to understand sort of what went into this disappointing guidance. Hopefully we'll get that on the call. Back over to you.
Okay. Courtney Reagan, thank you. NVIDIA shares are closing lower today again after a big pullback on Wednesday. Now we're awaiting pricing for CoreWeave. Now, this is a company that rents out access to NVIDIA chips and which is expected to start trading tomorrow, one of the most hotly anticipated IPOs of the year. Leslie Picker has the latest for us. And Leslie, you've been reporting on this all day, including the fact that NVIDIA could be a so-called anchor tenant in this IPO listing, and the fact that NVIDIA is a stakeholder, too, in general.
Yeah, NVIDIA all around this one. Hotly anticipated, as you mentioned. Sounds like it's a bit coolly received. The whisper number right now is $40 per share, which is about 15% below the marketed range. And that's the price by which I'm told that NVIDIA, as you mentioned, agreed to serve as an anchor investor with an order worth about $250 million. Prior to the IPO, NVIDIA already owned 6% of CoreWeave. I'm hearing 3 big investors have put in orders for about half of the book, but they still may need to cut the amount of shares to better match demand. Final decisions taking place now that the market is closed. As with many deals, though, timing is everything. The AI fervor seemed unstoppable through much of last year, but earlier in 2025, the DeepSeek phenomenon called into question some of the CapEx figures on AI. And just earlier this week, Alibaba's Joe Tsai warned of a bubble in the AI data center build-out. And while its revenue has skyrocketed from just $16 million to $2 billion over the last 3 years, CoreWeave's losses have widened. Some analysts have suggested that some creative accounting has led the company to showcase higher gross margins than they actually enjoy. However, as potentially the biggest IPO of the year, there are a lot of eyeballs on how it does, especially given the number of other potential IPOs, be it Klarna or StubHub or eToro, that are now waiting in the wings, Morgan.
Yeah, I said anchor tenant. I meant anchor investor.
Kind of the same thing.
We were just talking about this. We were just talking about this with our market panel, and Barb Duran was just flagged it. The fact that you've got cash burn, you've got CapEx spending, in general, very heavy still. The debt load, chip depreciation concerns here, path to profitability, massive dependence on 2 hyperscalers for something like 3/4 of the revenue here as well. I mean, how much can we actually use this IPO offering to gauge how others are going to do in the market, given the fact that it is coming at a key moment of concern in general around the broader AI trade?
Yeah, no, all of those things put together tell you, they paint a picture for exactly why CoreWeave wants to go public, and also why CoreWeave really needs to go public to pay down that debt, to replenish some of the cash burn. I mean, all of that is extremely important for a company in that situation. Now, that also changes the leverage dynamic, and the buy side knows that, and therefore they may be pushing down the price a little bit more. So it is an idiosyncratic element in that sense. However, if you are a large mutual fund investor and you put money into CoreWeave, even if you get it at a discount and something happens tomorrow where it doesn't perform very well, that definitely affects other IPOs that are potentially in the wings, because it makes that whole risk dynamic just a little bit higher for new issues overall. It kind of creates more of a discussion around IPOs, even if they have a totally different financial profile and a different business and a different place that they operate. You're still largely dealing with a lot of the same potential investors to buy these deals, and it's a lot easier to sell them if they're making money on recent IPOs.
All right, Leslie Picker, thank you. Now let's get to senior markets commentator Mike Santoli for a look at market dynamics as the comeback attempt potentially stalls here. Mike?
Yeah, certainly. Pause, stall, hesitate. We're not sure which. We'll have to wait and see. But take a look at the breakdown of where the downside pressure has come so far this year. This is the S&P 500 excluding technology. And you see it's kept its head above water here, just above the flat line on a year-to-date basis, whereas you have the NASDAQ 100. That's driven principally by the mega cap growth stocks, down almost 6%. That's not to say that tariff-impacted stocks are not also acting as a drag. Obviously, transports have been weak. You've had industrials that are off like 8% from their high. But in general, the rest of the market outside of tech is finding a way to hang in there. Now, you guys were just talking about the speed of the correction, the S&P 500 year-to-date, which we just saw from February 19th down to a low a few weeks later. That is interesting. Now, historically, the faster a 10% drop, you can tend to have better upside results in the 3 to 6 months after that. Although you sort of see we're just sort of chopping around this, not even recapturing half of what was lost already. I wanted to sort of look at this. You have this nice high in the first part of the year and then a quick correction, and compare it to a year that some people are bringing up, 2018, which also, like this year, came after a very strong year the prior year, and 20% higher in the S&P 500. And what happened here was, guess what? A 10%, almost exactly 10% correction in about 3 weeks, 2.5 to 3 weeks. You did get a recovery, not a full recovery, not a very strong, exuberant one. A lot of people were complaining, wow, we didn't really see tremendous demand for buying that dip. You didn't really gain momentum, but the market managed to grind higher until we got to the latter part of the year. That's when it was perceived the Fed was staying too tight, and tariffs, they couldn't be shrugged off anymore. There was a slowdown scare, and you did get that mini quick 20%, almost 20% setback later that year. So nobody's necessarily prepared to predict exactly that, but it's the kind of thing that can happen if you don't get a really energetic response to a 10% correction relatively soon, Morgan.
And of course, 2018, to your point, was the year when in Trump 1, you did start to see tariffs and some of these policies go into effect in a more meaningful way. So it does raise the question, how much can we, and I know policy is going to dictate it, but how much can we turn and look back to that first Trump term to sort of get a gauge of how the market could play out here?
I think that it's worth just sort of keeping it, in mind, not just because of the same president is, exerting some of the same pressures along with the same policies, but because 2017 was an incredibly low volatility melt-up year. It's very similar to what we saw last year. There was strength in the underlying economy. The Fed was considered to be out of the way. And then you have this kind of back and forth reckoning with a different environment, a little bit of a volatility eruption. And then, yes, the market tries to look on the bright side to see if the policies are going to hit. By the way, the economy ended up being fine here. The Fed sort of stepped off the brake, and everything was okay. It really was mostly a scare in late 2018, but, it didn't feel good in the moment.
All right, Mike Santoli, looking back through recent history. We'll see you later this hour as well.
Yeah.
After the break, are animal spirits still present in the market? We're going to ask longtime bull Tom Lee if he sees upside in the second quarter after a downbeat start to the year. And we will talk more about Lululemon's quarter as that stock gets hit hard after disappointing guidance. You can see shares are down about 7% right now. Over time, we'll be back in 2.
/30.
Welcome back. Markets sliding in the final hour of today. BlackRock's Rick Reeder saying last hour that the animal spirits that helped drive the market higher at the end of 2024 are part of what's hurting stocks now. Take a listen.